Welcome to Houselux Estate, your reliable guide to the world of investment. Here at Houselux Estate, we believe in the power of knowledge. We're dedicated to demystifying the complex world of finance and investment, making it accessible to everyone, regardless of their background or experience level. Our mission? To empower you with the insights and tools you need to navigate the investment landscape with confidence. Whether you're a seasoned investor or just starting out, you'll find a wealth of informative and engaging content here. We explore a spectrum of investment opportunities, delve into their inherent risks, and illuminate the potential rewards. From blue-chip stocks to penny stocks, real estate to cryptocurrencies, we've got you covered. So whether you're looking to diversify your portfolio, understand the latest market trends, or simply learn something new, you're in the right place. Begin your journey to financial freedom with Houselux Estate. Today, delve into the world of penny stocks and learn how they can be part of your investment portfolio. Let's start by defining what penny stocks are. In the most basic sense, penny stocks are shares in a company that trade for less than $5 each. They're typically issued by smaller, less established companies and can offer a cost-effective way for investors to own a piece of a company. Now, why would anyone want to invest in penny stocks? The answer lies in their potential for high returns. Because these stocks are so cheap, even a small increase in the share price can result in significant percentage gains. For example, if a stock worth $1 increases by just 50 cents, that's a 50% return on your investment. And if you've invested a substantial amount, that 50% can translate to a significant profit. But it's not all sunshine and roses. Penny stocks also come with their fair share of risks. Because they're often from smaller, less established companies, there's a higher chance that the company could underperform or worse, go under completely. And because penny stocks are less liquid than their more expensive counterparts, you may find it difficult to sell your shares when you want to. Another risk comes from the lack of public information about the companies issuing these stocks. Many penny stock companies aren't required to file with the Securities and Exchange Commission, which means they don't have to disclose as much information as larger companies. This can make it harder for you to make informed investment decisions. So, while the potential for high returns is certainly there, it's crucial to remember that penny stocks can also be a high-risk investment. It's not a strategy for the faint-hearted. It requires a keen eye, a willingness to do your due diligence, and an appetite for risk. As we delve deeper into the world of penny stocks, we'll explore how you can mitigate these risks and make the most of your penny stock investments. Penny stocks can be a high-risk, high-reward investment strategy. Before investing in penny stocks, it's crucial to do your homework. This isn't just an old saying, it's the cornerstone of smart investing. Diving headfirst into the penny stock market without a solid understanding of what you're getting into can be akin to swimming with sharks. So let's look at how to avoid becoming lunch. First and foremost, research the company behind the stock. It might seem like a daunting task, but in the age of the internet, information is at your fingertips. Look for details about the company's operations, its business model, and the industry it operates in. This will give you an understanding of how the company makes money and its potential for growth. Next, you need to delve into the company's financial health. This is where reading financial statements comes in. These documents, often found on the company's website, contain a wealth of information. They'll tell you about the company's assets, liabilities, income, and outflows. They're a bit like a report card for the company's financial performance. But reading these statements is just the first step. Understanding key financial ratios is also crucial. These ratios, such as the price-to-earnings ratio, debt-to-equity ratio, and return on equity, can give you a snapshot of the company's financial health and performance. Remember, the goal here isn't just to pick stocks that are cheap. It's to pick companies that are undervalued. Companies that, despite their low stock prices, have solid financials and a strong business model. This might sound like a lot of work, and frankly it is, but it's worth it. The more you know about a company, the better equipped you'll be to make an informed decision about whether or not to invest in its stock. In conclusion, research and due diligence are vital when investing in penny stocks. It's not just about finding the diamonds in the rough, but understanding what makes them sparkle. Doing your due diligence can help reduce the risk of investing in penny stocks. Choosing the right trading platform and broker is an essential step in investing in penny stocks. Now, let's dive into the world of trading platforms and brokers. There is a myriad of trading platforms out there, each with its own unique features and benefits. Some platforms are designed specifically for penny stocks, offering tools and resources to help navigate these often volatile markets. Others are more general, providing access to a wide range of investment options. What's important here is to find a platform that suits your needs. Are you a beginner looking for educational resources? Or perhaps an experienced trader in search of advanced charting tools? Take the time to research the different platforms available, looking at things like their user interface, customer support, and of course, their fees. And that brings us to brokers. In the world of penny stocks, brokers play a key role. They're the ones who will buy and sell stocks on your behalf. But not all brokers are created equal. Some offer lower fees, while others provide more comprehensive research tools. Some are better suited for high-frequency traders, while others cater to long-term investors. It's crucial to choose a broker that aligns with your trading style and goals. But there's one thing that should be non-negotiable: regulation. Always ensure your broker is regulated by a reputable financial authority. This provides an extra layer of protection, ensuring that your broker is held to high standards of conduct and transparency. Remember, your broker is your gateway to the market. They'll execute your trades, provide you with market data, and often offer advice. So take your time in choosing one. Don't be afraid to ask questions, read reviews, and even test out their platform before making a decision. In conclusion, choosing the right platform and broker is not a decision to be taken lightly. It can impact everything from the fees you pay to the resources you have at your disposal. But with a little bit of research and due diligence, you can find the perfect fit for your investment journey. The right broker can make a big difference in your penny stock investment journey. Investing in penny stocks can be risky, but with the right risk management strategies, you can minimize your losses. Let's delve into some of these strategies. One of the most common risk management techniques is setting stop losses. Stop losses are like an insurance policy for your investment. It's a predetermined level at which you'll sell the stock to avoid further losses. This strategy can be a lifesaver when a stock's price takes a nosedive. Now picture this: all your eggs in one basket. Doesn't sound like a good idea, right? The same principle applies to your investment portfolio. Diversification is another key risk management strategy. By spreading your investments across different stocks or even different asset classes, you reduce the risk of a single stock or sector dragging down your entire portfolio. Another strategy is position sizing. This involves deciding how much of your portfolio to allocate to a single stock. A good rule of thumb is to invest no more than a certain percentage of your portfolio in any one stock, say 5%. This way, even if a stock turns out to be a dud, it won't wipe out your entire portfolio. Lastly, and perhaps most importantly, only invest money you can afford to lose. Penny stocks are inherently risky, and while they can provide significant returns, they can also lead to substantial losses. Therefore, your investment in penny stocks should be money that, if lost, won't affect your ability to meet your financial obligations or your quality of life. In conclusion, risk management is not about eliminating risk, but rather about understanding it and taking steps to mitigate it. It's about making informed decisions and being prepared for different outcomes. It's not a guarantee of success, but it certainly increases your chances of it. Remember, managing your risk is as important as choosing the right stocks. Investing in penny stocks can be an exciting and potentially rewarding journey. The road to success, however, is paved with thorough research and due diligence. Understanding the company, its business model, and financial health can make all the difference between a wise investment and a costly mistake. Choosing the right trading platform and broker is just as crucial. Not all platforms are created equal, and the right one can offer valuable insights, tools, and resources to help you navigate the penny stock market. But above all, remember that managing risk is the cornerstone of any successful investment strategy. Diversify your portfolio, set stop-loss orders, and never invest more than you can afford to lose. As we wrap up our journey into the world of penny stocks, it's clear that the potential rewards are there, but they come with their fair share of risks. Thank you for joining us on Houselux Estate. Remember to subscribe for more insightful content on investments. Until next time, invest wisely.